A very good afternoon and welcome to the FX Week Ahead live market analysis with myself, Giles Coughlin, Chief Currency Analyst. A very warm welcome to you. I'm really glad you could join us on this, a very important look ahead. We have the Federal Reserve meeting this week, so as a consequence, we should be expecting some potential volatility in the US dollar. Before we get into the meat of the webinar, please do remember that as we look at different entries, we look at different exits. The whole purpose of this webinar is from an educational perspective. So you look over the shoulder of myself, someone with a professional trading background, in order to reach trading decisions for yourself. You'll see the way that I go about understanding the market, the way I go about analyzing the market, and as you watch and learn over time, that will enable you to inform your own trading decisions in a much potentially much better, more comprehensive way that explains why the market is moving the way it is. I hope you can hear my voice and see my screen okay. If you have any problems, please do either contact me in the chat box or just ask a question. I will get and answer all questions at the end of the webinar, so don't be afraid to ask any questions as we go along. And remember, the only question that is a silly question is the one that you had but didn't ask. So please do make sure you ask questions. Now we're going to look at a number of different things as we come to this week. Now remember, the number one thing for you to realize is that the king of currencies is the US dollar, and the king of central banks is the Federal Reserve. Where the Federal Reserve leads, the rest of the world tends to follow. So if you just need to be aware that central banks are not all equal. It's not that the RBNZ, the RBA, the SMB, the Bank of England, the ECB, the Bank of Japan, the Federal Reserve are all on an equal footing. Some central banks have more influence, have more firepower. The Federal Reserve is the largest, and that makes sense because the US economy is the largest economy in the world, and in fact nearly 1/4 of the entire world's GDP comes from the US, and the second largest economy is the Chinese economy, which accounts for when you put China and US together, it's nearly 50% of the world's GDP comes from those two blocks. And of course, China recently overtaking the Eurozone as one of the largest trading blocks in the world. So what happens out of the Federal Reserve is going to be pretty important. We will cover that in some detail. We're also going to cover these issues. We're going to be looking at what we can expect for the euro after the European Central Bank policy decision last week. We're also going to look at what we can expect from the Fed. We're going to look at Australian inflation. We're next for gold, the medium-term outlook for the US dollar. We'll look at the different data points that are coming out today, and that should be there to help us. We'll also be looking at the Australian dollar, New Zealand dollar, and the potential sell idea that we still have for that. And also watching for US inflation data on Friday and the New Zealand dollar, Japanese yen, and the potential buy-buys. And we'll also chuck in a quick look at the FTSE 100. So we've got a lot to get through. So with that being said, I'm just going to go over to the one of the trading screen, and we can see where the charts are all lined up here. So first thing to look at,
interesting piece in Axios, which does report that
turn off the
profit margin.
Just one. The first thing we're looking at is we're next for the euro after the European Central Bank decision. Now, the European Central Bank decision, I'm going to send you a link in the chat box, so do check out this link. I did write a review that is on the blog now, and that review you can see here on the HYCM blog. If you just go to it and just go to the market fundamentals, go to Central Bank Watch, and you'll see the central bank, and this is the latest central bank information that I've been talking about with the euro. Now, the last central bank meeting was last week, and it was a dovish holding hand. Going into the meeting, expectations were that the ECB will be more dovish. Now, there's some disagreements going on behind the scenes because there's some very fiscally conservative members like Germany, and there's some fiscally liberal members like Italy and Greece, obviously, which have much higher debt levels. Now, the fiscal conservatives like Germany, Belgium, they're very keen not to keep borrowing money. whereas fiscal liberals like Italy are very happy to keep borrowing money. Now, the way the money borrowing is happening is through the issuing of European central bonds. There's two major bond purchase programs. There's the PEP, the Emergency Purchase Program, and there's the APP, which is your standard purchase program. The emergency program is 1,8750 trillion euros large, and the everyday APP purchase bond program is 20 billion euros per month. So huge amounts of borrowing going on for the Eurozone. Now, the expectation is that the ECB are going to change their purchase program by adding extra borrowing from the emergency program, which is due to expire 2022 next year, and they're going to add that to the standard purchase program. So in other words, more dovish. So going into the meeting, the euro was being sold off into the meeting, and you can also see, if you look at the German 10-year bonds, you can see how sharply the yields were falling. So expectations with weakness in the euro. Now, in the end, Christine Lagarde, they had an argument behind the scenes. A sources report from the Eurozone explained what the disagreement was. It was all about the extent of these bond purchases, with the fiscal conservatives wanting them to be limited, the fiscal liberals wanting them to be extended. So Christine Lagarde tried to have a holding meeting and has postponed the major meeting to September, where bond purchases will be discussed. So the euro has a sell bias, but in the near term, this is where we're going to find the direction from the euro is going to come from the Federal Reserve meeting midweek. Now, let me show you something. You must understand this. Now, I've put on the screen in the red line is a dollar index. And do you notice how the euro US dollar and the dollar index move in exactly opposite directions to each other? So when the dollar index falls, euro US dollar rises. When the dollar index rises, the euro US dollar falls. So this recent fall in the euro US dollar was prompted by the June dot plot shift from the Federal Reserve. So the markets are beginning to expect the Federal Reserve is going to normalize their policy. So in the near term, this is the significance. We know that the euro-US dollar pair is going to be pushed around by what happens to the dollar. What happens to the dollar is going to be decided by the Federal Reserve this week. So euro-US dollar direction is going to be decided by the euro dollar. Now, if you just look at this dollar index, if you just see that if I invert this scale, just see how closely the euro-US dollar follows. So you can trade the dollar index and the euro-US dollar interchangeably. So when one's falling, the other's rising. So it's very easy in that respect to trade the euro-US dollar because it's just doing exactly opposite of what the dollar is doing. So the recent dollar strength has been resulting in euro weakness. That also means the euro-US dollar pair is driven by both the euro and the dollar. So having a good understanding of what's happening with either will give you a good heads up about which direction to choose for the euro-US dollar. That's lesson number one. Right, so lesson number two is what to expect this week. Now, if we go to the calendar, what we can see is we've got a few big data points for the dollar. Tomorrow, consumer confidence. We then have the Federal Reserve meeting on Wednesday. We then have advanced GDP for second quarter on Thursday. And then we have the inflation data, PCE data on Friday. So a massive week for the US dollar. A couple of things to say. First of all, and please note these things, they're all important. The confidence of the consumers in the US is very important. Around 70% of the entire GDP of the US comes from its consumer base. So the US is a consumer-driven economy. So how consumers are feeling is important. Now, we've recently had uptick in COVID-19 cases in both the US and the UK, but crucially, COVID hospitalizations and deaths are down in both, certainly in the UK, are heavily down. And I think they're also down in the US compared to where they had been. So in other words, the vaccines are working. How is this going to impact US consumer? If the consumer confidence comes in high, that's going to be positive for the US dollar. If it comes in low, negative. We also have the FOMC statement on Wednesday. Now, be aware of this. There's no dot plot that's going to be shared on Wednesday. So with the Jackson Hole meeting not due till the end of August, this is almost certainly going to be a holding meeting. So investors are expecting this to be a holding meeting. Now let me show you something. Now look here in the dollar. Do you see that strong move higher in the dollar? That happened on the last dot plot shift from the Federal Reserve. In other words, the markets were expecting sooner interest rate hikes, sooner bond tapering, so the dollar strengthened, and the dollar has been strengthening since then. Expectations now, however, are that the dollar will start weakening and that Jerome Powell will be very dovish. So if Jerome Powell's hawkish, if he starts talking about bond tapering, if he says anything about bond tapering at all, that's dollar strength, and particularly look at the dollar yen. So this is a great trade that I'll be looking for if Jerome Powell is hawkish. Now, do you see here the US 10-year yields? You see how the US dollar yen tracks the US 10-year yields? If Jerome Powell talks about bond tapering coming or interest rate hikes coming, then the US dollar yen will rip higher and retest that 111.50, probably upwards to that 113, 114 level. Okay, so any hawkish development, expect dollar yen to hit 114. That is a false break of an inside bar. That technically signals higher prices, so watch out very carefully for that. Also, I'll come on to some other yen pairs that are putting some very important reversal signals, but that's important for the dollar. Now, looking past Wednesday, that's the most important event, the FOMC statement. But also, we have to factor in the PCE data and the GDP data on Thursday. So if the GDP comes in, say it comes in like 8.9%, 9%, that will result in strong upside in the US dollar. Anything above maximum market expectations would be dollar strength. Similarly, and that would be euro-US dollar weakness. Similarly, if the inflation data comes in hot, you see the month-to-month data is due to be coming in at 0.6%. Say that comes in, above, 0.9%, 0.8%, then expect a lot of upside in the US dollar as well. Okay, so big week for the dollar. Main event is the FOMC meeting on Wednesday. Any indication that the Federal Reserve is looking at bond tapering or hiking interest rates, that would be a straight dollar buy, and that would also be a straight gold sell. Gold at the moment is being very strongly driven by the dollar. If I just show you here, let me show you something. Right, this is how to understand what's happening with gold. Okay, on these charts, the dollar index is the purple line. The red line is basically a proxy for real yields, and the blue line is gold. So do you see, as real yields fall, the red line, gold rises. Recently, look, the real yields are falling again. Gold's been rising, but you see, gold's not rising as quickly here in July as it was in May and June of this year. Okay, so you can see gold was, really rocking up high up towards that 1900 region, but at the moment gold sat around 1800. So you can see it's $100 cheaper than it was in May, but real yields are significantly lower. Why? Now this is the answer. The reason is the dollar. Do you see here, as real yields fell, the dollar fell, and it was the falling real yields and the falling dollar which boosted gold. So at the moment, are real yields falling? Yes. Is the dollar falling? No. So if the dollar falls on Wednesday, I'm expecting gold to retest 1900 over the next few weeks. So if the dollar falls sharply, expect gold to start trekking higher. One possible way is just to look at looking at a break of that trend line on dollar or any bearishness from the Federal Reserve does open excellent opportunities for gold. It is a trade that I'm keeping a very, very careful eye on. Gold potential upside on a dovish Fed. So don't forget, come along on Wednesday and I will help you get exactly ready for the FOMC. In fact, really, it's something you can't miss. If you want to know how to trade the FOMC meeting, come along on Wednesday. I'll show us the currency pairs to be looking at. I'll show us what the triggers are, and I will really get us totally ready for that. Okay, that's good. So the other key events in the calendar is the Australian dollar inflation. Now, at the moment, Australia is seeing weakness in the Australian dollar for two reasons. One, the COVID Delta variant is spreading rapidly, resulting in further shutdowns in Australia. Two, Australia has only vaccinated around 15% of their entire population. So they are vulnerable. They can't do what the UK is doing. The UK has got rising cases and says, look, we'll just carry on business as normal because hospitalizations, deaths are lower. The general impact of the virus is a lot lower on those who've been vaccinated. So Australia can't do that. They successfully managed the outbreak, around the start of COVID. Now they're very firmly on the back foot. So that is a cause for Australian dollar weakness. CPI could give Australian dollar a little lift, but expect sellers on an E-lift high. So say that CPI comes in high, expect sellers. And a great pair that I would potentially consider suitable for short, and I am short currently, is the Australian dollar, New Zealand dollar pair. The outlook for this pair is tilted to the downside, and any retracements that 1.0650 I consider suitable for going short. Stops just above that 1.0750 level. Above the 200, 100 exponential moving average and looking for a retest down to that 1.0450 region. Why? Totally different outlook from the RBA and the RBNZ. I have on the blog a piece which I've written about the differing outlook between the RBA and the RBNZ. In fact, let me just put that down and I'll show, and I'll send out let's have a look. We've been looking for Aussie New Zealand dollar weakness for some time, and that's been playing out very nicely. Let's just see what, just see if I can find it. Should have it, there we go. That's my latest piece. I will send that out to you. Please look at that. Yes, Johann's asked for the link for Wednesday's meeting. I have to say, the Wednesday meeting link is just for HYCM clients. So, make sure that, if you're not an HYCM client, become an HYCM client, and then you can get that information. Here is the link to register coming now. Johann, here's the link. Any problems, please do contact support and we'll be very happy to help you. We love helping traders and it's something I enjoy a lot, and the Federal Reserve meeting, Johann, is a real key one to be ready for, and I'll show us how to get ready for that. Looking at the inflation data, so look at that. So expect any moves higher to be faded because the divergence between the RBA and the RBNZ, I've sent the link. It takes a little bit of time for you to read through it. You can read through that now. Wednesday, Canadian dollar CPI. Now, inflation data is going to be important for CAD. Just to recap what's been happening with CAD. Now, the CAD has been drifting higher, the US, since April, where the Bank of Canada had a hawkish rate shift. They tapered their bond purchases from 4 billion Canadian dollars per week to $3 billion per week. And then they also, in their last meeting, have tapered bond purchases another further $1 billion from $3 to $2 billion per week. Now, why is the CAD losing a bit of value? Well, a couple of things. One, oil's been a bit weaker. So there's been some weakness in oil after the OPEC Plus decision last week to curb production cuts next year. And also the US dollar strength. Okay, so look out if we have reasons. This is a very bearish development here. if we have a reason to sell the US dollar after Wednesday, and we have a strong GDP print on Thursday, so if that comes in strong, say, let's look at it here, if it comes in like above 0.7% on the month-on-month, then we'd expect to see a lot of strength in the Canadian dollar. If the median comes in above, let's say 2.7%, then we'd expect US dollar CAD weakness. We need two things. We need a bearish Fed and we need a strong GDP. That bearish pin bar is essentially opening up downside in the pair potentially. So look out for that. If you don't like the US dollar CAD, the other option is to trade the Aussie dollar CAD. Now, the Aussie dollar, as we've mentioned, has some reasons for weakness, right? Because of the diverging outlook in the Australia with the rising COVID-19 cases, etc., etc. That's a bearish development. We have a bearish outside bar. We have a false break of that 0.9400 region. And then we can potentially look at this level breaking. Apologies for my cat who's saying hello. As that level breaks, we'd expect a move lower, potentially down to that 0.9100 region. So a strong Canadian GDP data, the Aussie CAD looks very good for potential shorts. We have reasons for Australia dollar weakness, remember. If the CAD comes in stronger, then we could see a little bit of a further shift lower in Aussie CAD. Don't miss it. The next important data point is on Friday. GDP data out CAD, same outlook potentially as before, Aussie CAD potentially downside, and core PCE data for the US. This is the Fed's preferred reading of inflation. If it comes in high, that's dollar positive. Okay, so you can potentially use that information, but obviously that's coming in after the Fed meeting. The main bell of the ball, so to speak, is the Fed meeting on the Wednesday. Right, now here's a couple of other things I want to point out to you. First of all, stocks, there is a good opportunity that's setting up in the FTSE 100. As long as risk sentiment remains positive, this is a bullish pin bar development. Now, the outlook for UK stocks is still good. Low interest rates, very loose monetary policy and fiscal stimulus from the UK government. We also have the fact that UK economy is opening up. So it wasn't a surprise to see the dips being bought. And I was buying into these dips as we moved into this level, and I am long FTSE 100, and I'm looking for a retest up to that 7,150, then it's 7,200, then it's 7,500. You see this gap? I am expecting and waiting for this gap to fill in the FTSE 100. It's a clear no-brainer trade for me. I've been looking for this for some time. So technically, the way this can be entered is potentially entered at market, stops below 6,750, and then looking for a retest up to that 7,500 region. Okay, that's one opportunity that's there. Now, what's the risk? Every trade has risks. If there's a new variant in the UK, if there's further lockdowns in the UK, if there's strong risk-off sentiment in the UK, all of those would negate the outlook. At the moment, that does look very good for a test of 7,150, then 7,200. The other option is to wait for a break of this region here, the 7,200, and then go for a retest, looking for a move back up to 7,500. So that's another option for more conservative traders. The other pair that's really worth looking at is risk positive pairs. So if you take a look at the New Zealand dollar, now I really like the New Zealand dollar. Let me just show this. Now you see here, the New Zealand dollar. Okay, we've had some great data out of the RBNZ. So number one, we've had the fact that the RBNZ surprised markets at their last interest rate meeting. And don't forget, you can find out all the information you need. Just go along to the Central Bank Watch, and you can see here, I mentioned what can we learn from the RBNZ. and I explained the headline surprise was that the RBNZ agreed to halt additional asset purchases under the large-scale asset purchase agreement by July the 23rd. That has happened. Okay, this means the RBNZ can consider setting up for a sooner rate hike than previously projected. This is a move higher in 10-year bonds, and it gives New Zealand dollar upside. Okay, so I was looking at expecting sellers from the Aussie New Zealand dollar, and you can see that we've seen a lot of sellers come into that, right? Also, I'm expecting buyers in the New Zealand dollar Japanese yen. Now, why did it drop lower last week? It was the risk off sentiment. So when risk sentiment is off, it means the yen is bought. The Bank of Japan is very dovish and expected to be dovish. The RBNZ is expected to now raise interest rates by the 4 largest investment banks in New Zealand. They're expecting to raise interest rates by next month. Can you believe it? So the expectations are for strength. Now, that makes this a very clear buy, looking for a retest into that 79 region. So for me, the risk to that trade, okay, make sure you understand the risk to this trade is if the risk sentiment turns off. Now, one way it could turn off, and this is a risk you have to be aware of, is if the Federal Reserve signal earlier interest rate hikes. Remember, rising interest rates means that companies' debt becomes more expensive. If companies' debts become more expensive, it means that companies' earnings are impacted. If companies' earnings are impacted, then the global indices will fall. So an early interest rate shift will send equity markets falling, which will also potentially cause the yen to gain on risk-off trading if it becomes very sudden, which would negate the outlook of this trade. So it's a good trade technical setup. The fundamentals are in place, but the risk is that if the Federal Reserve raise interest rates or signal it, this will likely fall lower. It could take out the lows. For now, I am long New Zealand dollar Japanese yen. I was buying into this dip last week, and I'm looking for higher prices. Now, another alternative to the New Zealand dollar Japanese yen is the pound yen. Now, I really like the pound yen upside. Before I just quickly look at the pound Australian dollar. Remember, the pound Australian dollar, I'm looking at taking profit just in this 1.800 region. I've been long the pound Australian dollar from about 1.8300, so sort of around 500 points up on this. I took a little bit of profit last week and then re-entered a smaller position. But basically, I've been long from around this 1.8300 region. So I'm nearly closing out my final position up at the top there. So that's been a great run. And that was on the diverging outlook between Australia and the UK. So that's nearly hit target. So those of you still long pound dollars, that's where I'm taking profit. Any retracements to that 1.8500 would still be considered suitable for longs, okay, at the moment. So watch out for that. The pound yen is, again, I'm expecting a more bullish outlook from the UK. Now this is looking very strong, okay? I'm expecting this to push higher. If we go above that 1.56, I'm looking for a move up to 160, okay? I'm looking for a move up to 160. So the entrance would be at market, stops below 148, looking for 160. But here's the risk. The risk is the risk off trading. So anything risk off, risks this trade. But for now, pound yen, very clear upside bias. That's a great opportunity in terms of the technicals and fundamentals. Just going to make sure the story keeps going. There is also a very interesting move higher in Ethereum. Now, what's been going on in Bitcoin is the fact that Jeff Bezos has been rumored to maybe he's going to start expecting Bitcoin payments on Amazon. Now, remember, when Bitcoin rises, Ethereum tends to rise with it as well. So just take a look here and you will see that there's a hidden bullish divergence in Ethereum, okay? So this is possible to enter at market with stops below the low, and I'm looking for a retest up towards that 323,600. Now, I'm not trading this, but I'm just noticing there's a hidden bullish divergence, which is a big signal of higher prices. So you always have to manage your risk very carefully, and cryptocurrencies have been horribly volatile recently. And one way of staying with it without having a massive stop is to either enter at market, and then as long as price stays above that trend line, stay with it. If price moves back below the trend line, exit. Or the other option is any retracement back down to that 200 region, go long, and just keep your stops tight below that 100 exponential moving average. Make sure you always understand how much total you have at risk. With some of the volatility in cryptocurrencies, you can get caught out very easily. Do not risk too much. It's foolish. Don't be a hero that ends up with zero. So that's it, folks. So let's have a look. Is there anything else to say? No, there isn't. Lots and lots of potential opportunity, but also some risk out there in the markets as well. I hope that's been helpful. Don't forget, I will be back here, scheduled to be back here on Wednesday, and I will get us ready for the FOMC. So really, it's a webinar you absolutely can't miss, because the movement of the FOMC is almost certainly going to be the catalyst to a number of those trades. So I will show you an outline to you what to look at, where to establish your risk, and how to manage that. I hope that you can make it. It's been a pleasure as always. I hope you have a great weekend. You're very welcome, Sarah. Thank you, Johan. Good to have had you here. Selva, as usual, great to have you. Olufemo, John, Eddie, Ibrahim, Antonio, Alexandro, Vladimir, Warren, always a pleasure. Patrick. Okay, folks, Ibrahim, take care, guys, and have a very good one. Thank you now. Goodbye.